Welcome back to the deep dive. Today we are strapping ourselves into well, a very expensive and very complicated machine.
A dangerous one, too, if you don't know what you're doing.
Yeah, exactly.
Ah.
I want you to picture the cockpit of a massive jumbo jet. You know the image. You've seen it in a dozen movies. You've got buttons everywhere, flashing lights, radar screens, and those distinct sheepskin-covered seats for the pilot and the co-pilot.
It looks incredibly cool.
It does. It looks powerful. It looks like the ultimate control center. But you can't just, jump into that seat, throw on some aviators, and fly the plane.
Right, there are protocols.
Yeah, manuals thicker than phone books, strict federal regulations about who sits where, how long they can fly, and what happens if they fall asleep at the wheel.
Yeah.
And today, we aren't talking about aviation at all.
No, we are talking about the corporate cockpit.
The C-suite. The boardroom. We see these titles in the news constantly, right? CEO, managing director, CFO, and they seem like these untouchable masters of the universe. We imagine them just doing whatever they want, buying islands, merging companies on a whim.
It's a very common misconception. The reality of that cockpit is far less about feeling cool and far more about strict adherence to a massive legal instruction manual.
And that manual is what we have in front of us today. It's essentially the rule book for becoming a boss and the safeguards that stop you from becoming a dictator.
Precisely. For our deep dive today, our source material is Chapter 13 of the Companies Act, 2013. Specifically, we're going to be unpacking sections 196 through 205.
Which deals with corporate and economic laws regarding the appointment and remuneration of managerial personnel.
That's the one. It covers who can be hired, exactly how much they can be paid, down to the literal percentage of profits, and how they can be fired.
Our mission today is to decode this legal text for you, because it governs the key managerial personnel, the KMP.
Which sounds a bit like a secret government agency.
It does, the KMP. But it's actually just the corporate squad. We're going to break down the age limits, the salary caps, the golden handcuffs, and the golden parachute, so let's just get right into it. Segment 1. The cast of characters. Who is actually allowed to fly this corporate plane?
Well, under Section 2, subsection 51 of the Act, we get the exact legal definition of the key managerial personnel. It's a legally defined group that includes the chief executive officer, the managing director, the manager, the company secretary, the whole-time director, and the chief financial officer.
Okay, CEO and CFO, we know those. Face of the company, money of the company. But you said managing director and manager as if they are two completely different things.
They are.
Because in normal, everyday conversation, if I say, I'm the manager, that could mean I run a fast food franchise or I run a tech empire. It's a generic word.
It is generic in conversation, but in the eyes of this law, the distinction is critical. In fact, it leads us to one of the most important rules in Section 196, subsection 1. It's what I call the one or the other rule.
One or the other.
A company is strictly prohibited from appointing both a managing director and a manager at the same time.
Wait, really? You can't have both. That seems completely counterintuitive. Don't you want as much management as you can possibly get?
You want management, but you definitely do not want conflicting command structures. To understand why this rule exists, we have to look at how the law defines these two roles. A managing director, under Section 2, subsection 54, is a director entrusted with substantial powers of management.
Substantial powers, okay.
But a manager, under Section 2, subsection 53, is an individual who has the management of the whole, or substantially the whole, of the affairs of the company.
Ah, I see the conflict now. If the MD has substantial powers and the manager manages the whole thing, they're basically going to be stepping on each other's toes constantly.
Exactly. It creates an immediate power struggle. It overlaps authority. If you have two people at the top with total control, you get chaos. Imagine you're the VP of sales. Who do you report to? The person with substantial power or the person managing the whole company?
The law says pick a lane.
Exactly. Do you want an MD structure or do you want a manager structure? You cannot have both.
But let's stress test this a bit. Because every company has people with the title of manager. You have a marketing manager, an HR manager, a finance manager. Are you telling me that a company with a managing director cannot legally have a finance manager?
No. And that is actually the most common point of confusion. The source material clarifies this with a really great example. They refer to it as the Sukanya Limited case.
Okay, let's unpack Sukanya Limited. How does that work?
So imagine Sukanya Limited appoints a Mr. Rajaram as their managing director. He's got the big chair. He's on the board. A year later, the company wants to promote a really dedicated employee, Mr. Rakesh, to be the manager of the finance department.
Which sounds totally reasonable. The guy watching the cash flow.
It is reasonable and perfectly legal because Mr. Rakesh, as the finance manager, is only managing a single department. He does not have management of the whole or substantially the whole of the company's affairs. Therefore, he doesn't fit the strict legal definition of a capital M manager under Section 2, subsection 53.
So the title on the business card doesn't matter nearly as much as the legal scope of the role. If you aren't running the entire show, you aren't the manager that creates that legal conflict.
Precisely. You can have an MD and a finance manager. You just can't have an MD and a corporate manager who runs the entire business. It is all about the scope of control.
Okay, that makes a lot of sense. Now, what about the difference between a managing director and a whole-time director? Because they sound very similar, and in smaller companies, they often seem to be doing the exact same thing.
They do get confused a lot. A whole-time director, or WTD, is defined in Section 2, subsection 94, and it simply means a director who is in whole-time employment of the company.
So it's mostly about their employment status. They clock in, they clock out, they draw a regular salary as an employee.
Correct. A managing director, however, is defined by their power. They are entrusted with those substantial powers of management we talked about. And here is a very crucial nuance. An MD must be a director first.
Wait, meaning what?
Meaning if, for any reason, they lose their seat on the board of directors, they strictly and immediately cease to be the managing director.
Oh, that's like a trapdoor. So the directorship is the foundation of the whole role.
Yes. And regarding those substantial powers, the Act actually clarifies that this does not mean routine administrative stuff. Signing share certificates, affixing the common seal to documents, drawing checks.
The day-to-day paperwork.
Right. Those are administrative tasks. You can delegate those to a clerk. Substantial power means high-level strategy. It's the difference between steering the ship and just, painting the deck.
So if you're just signing the checks, you aren't an MD. You need to be setting the course for the whole company.
Exactly.
Okay, so we know who the players are. Now, let's say I want the job. I want to be the managing director. I want to be the pilot of this jumbo jet. How do I actually get hired? This brings us to segment 2, getting hired and the rules of appointment under Section 196. I imagine it's a bit harder than just submitting a resume on LinkedIn and grabbing a coffee.
Just a bit, yeah. Before you even get to an interview, we need to check if you're legally eligible. There's a very strict checklist. Let's start with age. The rule is strictly 21 to 70.
You have to be at least 21.
Yes. No teenage prodigy CEOs running public companies. The law assumes a certain baseline of maturity is required when you're handling public money.
Fair enough. And on the other end, you strictly cannot be older than 70.
Correct.
That seems, well, frankly, controversial. I mean, a lot of very famous, very successful business leaders work way past 70. Look at Warren Buffett. He's well into his 90s. Does this mean in India, once you hit your 70th birthday, security just escorts you out of the building?
You aren't fired immediately, but you do hit a massive regulatory wall. The law says you can hire or continue to employ someone over 70, but the bar is significantly higher. It requires a special resolution by the shareholders.
Let's pause there. A special resolution. That implies a supermajority.
Right. Yes, usually a 75% approval from the voting shareholders. And importantly, the explanatory statement that gets sent to the shareholders before the vote must specifically justify why this older person is needed.
So you have to make an affirmative case.
Exactly. You have to prove their experience, their health, their fitness for the role. You can't just slide it through as a routine agenda item at the annual meeting.
You basically have to say, we need him because he's a genius and we can't survive without him.
Essentially, yes. You have to prove they're indispensable. Now, there is an interesting fallback mechanism here. Let's say you try to pass that special resolution to keep your 71-year-old CEO. You go to the shareholders, you make your case, but you fail to get that 75% supermajority. Let's say you only get 60%.
So a simple majority wants him, but a blocking minority says no.
Correct. In that specific scenario, if the votes in favor still exceed the votes against, you can apply to the central government. If the government is satisfied that the appointment is truly beneficial to the company, they can override the lack of a special resolution and approve the appointment anyway.
That is a fascinating safety valve. It prevents a minority of shareholders, say, a coordinated block of 26% from holding the entire company hostage and blocking a perfectly capable leader just because of a number on their birth certificate.
Exactly. It allows for nuance in corporate governance. And this isn't just theoretical. There was a very significant case regarding this. Sridhar Sundarajan versus Ultramarine and Pigments Limited. The Bombay High Court actually had to decide on a very tricky timeline issue.
What happened in that case?
The question was about when the rule applies. Imagine someone is appointed as MD when he is 68 years old for a standard 5-year term. He turns 70 right in the middle of his term. Does the 70-year rule kick in on his birthday, or does he get to finish his 5-year contract because he was eligible on the day he started?
Oh, that's a great dilemma, because common sense might say, look, I signed a contract for 5 years, you knew my age, let me finish it. But the law is usually stricter than common sense.
And the court took a very strict interpretation. They said, no, you don't get to just finish the term. The protection is designed for the company and the shareholders. The moment you hit 70, the requirement kicks in immediately.
Wow.
You need that special resolution to continue the person past 70, even if their original appointment was perfectly valid.
But it's incredibly strict. Birthdays literally matter in the boardroom. It really emphasizes that the shareholders need to actively and continuously consent to having an older leader. It protects against what you might call senility risk, or just ensures there's a mechanism for fresh blood.
Exactly. The shareholders have to reaffirm their trust.
So that's the age limit. What else disqualifies you? You mentioned a bad list earlier.
Yes, the bad list in Section 196, subsection 3, is quite comprehensive. It's designed to keep the C-suite clean. For starters, you cannot be an undischarged insolvent, basically if you are currently bankrupt.
Which makes total sense. If you can't manage your own personal wallet, you probably shouldn't be managing a massive company's treasury.
Precisely. You also cannot be someone who has suspended payments to your creditors at any time. That's a huge red flag for financial distress and mismanagement. And crucially, you cannot be a convict who was sentenced to imprisonment for a period of more than 6 months.
6 months implies a reasonably serious offense.
Yeah.
We aren't talking about a bad speeding ticket or a minor scuffle here.
No, we are talking about crimes involving moral turpitude or significant breaches of the law. And there's also a very specific mention of individuals detained under COFEPOSA.
COFEPOSA. That is quite a mouthful. What is that?
It stands for the Conservation of Foreign Exchange and Prevention of Smuggling Activities Act.
Okay, so strictly speaking, absolutely no smugglers allowed in the C-suite.
That is a very good rule of thumb, yes. No smugglers piloting the corporate plane.
Good to know. Now, let's talk about tenure. Let's say I pass the background check, I'm the right age, I get the job. Do I have this job for life?
Absolutely not. The maximum term for a managing director, full-time director, or manager is 5 years at a time.
5 years. Can I be reappointed after that?
You can, but there is a catch. You cannot reappoint someone earlier than 1 year before their current term expires.
Why do they have that specific rule? Why not just renew a good CEO whenever you want?
It's to prevent entrenchment. Imagine you are a powerful CEO. You have 4 years left on your current contract. You use your influence to force the board to renew you for another 5 years right now. You have just locked yourself in for 9 years total.
Ah, I see. It's an anti-monarchy provision. It stops you from building a dynasty.
Exactly. The law wants the shareholders to have a say much closer to the actual expiration of your term, so they can judge your recent performance. You simply cannot lock in your job a decade in advance.
That makes a lot of sense. And I think the source material mentioned a specific example about this, someone who actually tried to be appointed for life.
Yes, example 1 in our notes. This person, Mr. X, was appointed as managing director for life by the Articles of Association of a private company. Now, people often think private companies can just do whatever they want. They think, hey, it's my company, I own the shares, I set the rules.
Right, it's private property.
But Section 196 says no company, whether public or private, can exceed the 5-year term limit for managerial personnel. So that appointment for life clause in their articles completely void.
So even if you literally own the place, legally, strictly speaking, as an MD, you serve 5-year terms. It forces a periodic mandatory review of your leadership.
Correct. It forces the company to stop and ask, is this person still the right fit for where we are going?
Now, let's walk through what the notes called the procedural dance of Section 196, subsection 4, because it's clearly not enough to just shake hands and give someone the corner office.
No, it is a very structured 3-step process. Step 1, the board of directors approves the appointment at a formal meeting. They check the eligibility, they agree on the terms and the pay. Step 2, the shareholders have to approve it at the very next general meeting.
And step 3?
Step 3 is central government approval. But that's only required if the candidate breaks any of the rules laid out in Schedule V of the Act, like if they had a past conviction or didn't meet certain residency requirements in India. And finally, to make it all official, the company has to file a return, specifically Form MR1, with the Registrar of Companies within 60 days.
Okay, I noticed something really interesting in the notes about the validity of acts under Section 196, subsection 5. It sounds a bit like a loophole, but a really necessary one.
It is a critical protection clause for the broader economy. Let's play out a hypothetical scenario to see why it's needed. Let's say the board appoints a brand new MD in May. The general meeting for the shareholders to confirm him isn't scheduled until late June. In those few weeks in between, the new MD signs a massive multi-million-dollar contract with a supplier for raw materials.
Which is standard business. You can't just pause the company for a month.
Exactly, standard business. But then in June, the shareholders meet. And they look at this new MD and they say, no, we actually don't like this guy, and they vote to reject the appointment. He is immediately out.
So what happens to that massive contract? Is it void? Because that would be an absolute disaster for the supplier who just shipped a ton of materials based on a signed agreement.
Precisely. That's why Section 196, subsection 5 steps in and says no. The acts done by that MD before the rejection are explicitly deemed valid.
That is huge, because otherwise every third-party vendor or partner dealing with the company would be terrified that the CEO might get fired a month later and their contract would just vanish into thin air.
Exactly. It protects the flow of commerce. It protects the innocent third parties, not necessarily the failed MD. It ensures that the company has to stand by its commitments, even if the person who made those commitments is subsequently shown the door.
Moving on to segment 3, the golden handcuffs. We are talking about obligations under Section 203. Let's start with the basics. Who is actually required to have these key managerial personnel?
Well, not every mom-and-pop shop needs a full KMP squad. The mandatory requirement applies to every listed company, so if your shares are traded on the stock exchange, you need the whole team. MD or CEO, CFO, and company secretary. It also applies to unlisted public companies with a paid-up share capital of 10 crore rupees or more.
What about private companies? Because usually they get a pass on these really heavy compliance regulations.
Private companies are generally exempt from the full KMP requirement, with one major exception under Rule 8A. If a private company has a paid-up capital of 10 crore rupees or more, they absolutely must have a whole-time company secretary.
That really underscores the importance of the company secretary, doesn't it? Even in private, closely held firms, once you get big enough hitting that 10 crore mark, the government says you need a dedicated compliance officer. It's a recognition that you are big enough to cause real damage if you don't follow the rules.
Absolutely. The company secretary is the backbone of corporate governance. We'll dive deeper into their specific duties later, but they are essential for keeping the company out of legal trouble.
Now, here is a rule that affects corporate governance deeply, and it's something debated all over the world. The chairperson versus CEO split. The general rule in the proviso to Section 203, subsection 1, is that an individual cannot be the chairperson of the board and the managing director or CEO at the same time.
This is a huge debate globally. It comes down to the separation of powers. The chairperson's job is to run the board of directors. The CEO's job is to run the company. If they are the exact same person, the board cannot effectively supervise the company.
Exactly. You want the board to hold management accountable. If the head of the board is also the head of management, who's watching the watcher, it just creates an echo chamber.
Precisely. It's about fundamental checks and balances. You need tension between the board and management for healthy governance.
Are there exceptions to this? Because we see this combined role often in the U.S. and, frankly, sometimes in India, too.
Yes, there are exceptions. If the company's articles of association explicitly allow for the roles to be combined, or if the company operates multiple distinct businesses with separate CEOs for each business, then one person can hold both top titles. But the default stance of the Indian law is to separate them. It heavily prefers a non-executive chair to oversee an executive CEO.
Okay, let's talk about moonlighting. Can I be the CEO of two different companies at once? You look at someone like Elon Musk, who seems to run Tesla, SpaceX, and others simultaneously. Does Indian corporate law allow for an Indian Elon?
In the Indian context, under Section 203, subsection 3, the general default rule is one job only. A whole-time key managerial personnel cannot hold office in any other company.
Which makes sense. Whole time implies, well, your whole time. You can't give 100% of your effort to two different places.
However, there are exceptions to this as well. You can be a regular, non-executive director in another company, provided your own board gives you permission, and you can be the managing director of a direct subsidiary of your company. But the most interesting exception is what we might call the double MD loophole.
I do love a good loophole. How does that one work?
It's found in the third proviso to Section 203, subsection 3. You actually can be a managing director of two separate companies, but the procedure for approving that second appointment is incredibly strict.
How strict are we talking?
You need to convene a specific board meeting. You have to give specific detailed notice to all the directors that this dual appointment is on the agenda. And this is the real kicker. You need a unanimous board resolution. Every single director present at that meeting must agree.
Unanimous. Not just a simple majority.
Unanimous. If even one director abstains from voting or votes no, the deal is completely dead. The source material gives us the Virasat Limited example, which illustrates this perfectly.
Tell us about the Virasat case.
So Virasat Limited wanted to appoint a Mr. Vaccaria as their managing director. But Mr. Vaccaria was already an MD at another company, so they held the required board meeting to approve this dual role. 8 directors were present at the meeting. 6 of them voted yes. 2 of them abstained, meaning they didn't vote no. They just sat there, withheld their vote, and stayed silent.
Now, in a normal board vote, 6-0 with 2 abstentions is a landslide win. The motion carries easily.
In a normal vote, yes. But here, the appointment was ruled invalid. The law requires the affirmative consent of all directors present. Abstaining is not consenting.
That is fascinating.
It is, because having a part-time managing director is seen as a massive risk for the company. The law essentially says if you're going to take that huge risk, the board must be entirely united on the decision. There's absolutely no room for doubt or hesitation.
That is a crucial detail for anyone operating in this space. Silence effectively means no in that specific vote. It really shows how risky the law considers a divided focus at the top.
Precisely. If the leader isn't fully committed to one company, the board better be fully convinced it's still a good idea.
All right, let's get to the part I'm sure everyone has been waiting for. Segment 4. Show me the money. Section 197. How much can these people actually get paid? Because we constantly hear about exorbitant CEO salaries, stock options, massive bonuses. Is there a hard limit in India? Or is the sky the limit?
This is where the Companies Act gets very mathematical, and frankly, you can see its slightly socialist origins. Section 197 sets an overall hard ceiling. The total managerial remuneration payable by a public company cannot exceed 11% of the net profits for that financial year.
11% of the net profits. That's the entire pie.
That's the whole pie, and that covers all the directors, managing directors, and managers combined. If the company makes 100 rupees in pure profit, only 11 rupees maximum can go to the top management team.
Wow. And what if you want to pay more? Say you want to hire an absolute superstar CEO who demands 15% just for themselves.
If you want to exceed that 11% ceiling, you have to get a shareholder vote in a general meeting. It forces the board to go to the actual owners, the shareholders, and ask for explicit permission to take a bigger slice of their profits.
Okay, so 11% is the total pot. How is it sliced up individually? Can one very greedy CEO take the entire 11%?
No, the law anticipates that too. There are sublimits. If you have just one managing director or whole-time director, they can take up to 5% of the net profits personally.
5% of the profits for one person, which, if the company's doing well, is a very substantial amount of money. If a big corporation makes 1,000 crores in profit, that's 50 crores for the CEO.
It is a huge amount. But if you have more than one, say 2 MDs and a WTD, they all together are capped at 10% of the net profits. They have to share that 10% slice.
Which naturally encourages a leaner top management team if the executives want to maximize their individual paychecks.
Correct. And then you have the regular directors, the non-executive ones who aren't full-time employees. If the company has a managing director, the regular directors get a maximum of 1% of the profits to split amongst themselves. If there is no managing director, the regular directors can get up to 3%.
Wait, hold on. Why do they get more money if there is no MD?
Yeah.
That seems entirely backwards. Shouldn't the pay be lower if there's no top executive?
It's actually quite logical when you think about the workload. If there is no managing director running the day-to-day strategy, who is doing it? The regular board members probably have to step up and do a lot more heavy lifting. They are more involved in operations, so they deserve a higher cap to compensate for the extra effort.
Okay, that makes sense. Compensation matches the required effort.
Yeah.
But here is the really big question. What if the company makes absolutely no money? What if there are no profits? We see startups or turnaround companies all the time that are burning through cash and posting massive losses. Does the CEO just have to work for free?
No, that would be completely unrealistic. You wouldn't be able to get any top-tier talent to come in and save a failing company if you said, we can't pay you a dime until you fix everything. This is where Schedule V, Section 2 of the Act comes in. It specifically deals with remuneration in cases of no profits or inadequate profits.
How do they calculate the pay then? Because you obviously can't take 5% of zero.
Correct. They switch from profit to a different metric entirely, called effective capital. It's basically the company's financial war chest. It's calculated as the paid-up capital plus reserves plus long-term loans minus any accumulated losses and investments. It's a measure of the total capital actually employed in running the business.
Okay, so it's based on how big the company's financial footprint is, regardless of its current year profit or loss.
Exactly. And it operates on a strict sliding scale. Let me break down the tiers for you. If your effective capital is negative or less than 5 crore rupees, the maximum annual pay for a manager is capped at 60 lakhs.
Okay, so a small or deeply struggling company caps the CEO at 60 lakhs a year.
Right. If the effective capital is between 5 crore and 100 crore, the maximum goes up to 84 lakhs. If it's between 100 crore and 250 crore, the cap is 120 lakhs.
And what if you were a giant, massive corporation with over 250 crore in effective capital, but you just had a bad year?
In that top tier, the cap is 120 lakhs plus 0.01% of the effective capital that exceeds 250 crore.
So there's a very specific formula. You can't just raid the bank account of a failing company.
Right. And importantly, these are just the default limits. You can actually double these limits if you pass a special resolution with the shareholders. But there is always a mathematical tether to the company's actual size and resources. It's designed to prevent looting. It prevents a scenario where the company is rapidly sinking, but the captain is busy filling his own pockets with gold before jumping off the ship.
That's a great safeguard. Now, what about the doctor scenario? I saw a note in the source material about a Dr. Hamilton. This sounded like a character from a medical drama.
Ah, yes. The professional services exception. This is found in Section 197, subsection 4. And it addresses a very specific, very practical problem. Let's say you have a large hospital company. One of the directors on the board is a Dr. Hamilton, who happens to be a world-famous, incredibly skilled heart surgeon.
Okay, so he brings immense prestige and medical expertise to the board.
Exactly. He sits on the board, so he gets his standard director fees, but he also actually performs surgeries at the hospital. The question is, can he get paid for performing those surgeries? And more importantly, does his surgery fee count towards that strict 11% managerial remuneration cap we talked about?
I would assume.
Yes.
I mean, he's a director getting money from the company. It feels like all money going to him should count against the cap.
The answer is actually no, provided certain strict conditions are met. If the services rendered are of a purely professional nature, and the company's nomination and remuneration committee agrees that he possesses the requisite professional qualification, which, as a renowned surgeon, he clearly does, then that professional fee is completely exempt from the managerial remuneration caps.
That is fascinating. So he can earn his full premium market rate for doing surgery, plus his regular director fee, and the massive surgery money doesn't clog up the 11% limit for the rest of the management team.
Correct, because that money is compensating him for his technical skill as a surgeon, not for his high-level role as a manager of the company. It's paying for the trade, not the title.
That's a very practical exception, because otherwise, no true expert, no top-tier lawyer, no elite surgeon, no superstar engineer would ever join a corporate board, because they'd either have to take a massive pay cut on their actual work, or they'd mess up the pay structure for everyone else on the board.
Exactly. The law wants experts on board, so it created a sensible carve-out for them.
Now, let's talk about sitting fees. This is literally getting paid just to sit in a chair, right?
Well, ideally, you are also using your brain and offering guidance while sitting in that chair. But yes, directors get paid a specific fee for attending board meetings or committee meetings. The cap on sitting fees is currently 1 lakh rupees per meeting.
1 lakh per meeting. Not a bad way to spend a Tuesday afternoon.
It sounds like easy money, but you have to remember, the legal liability of a director is huge. You are putting your personal reputation and sometimes your personal assets on the line. And there is a very crucial equity rule built into this section. Independent directors and women directors cannot be paid less sitting fees than other directors.
Oh, really? That's specifically written in?
Yes. You can't have a situation where a company says, well, we'll pay the promoter directors who own the company 1 lakh per meeting, but we'll only pay the independent directors 20,000. That is strictly illegal. The fee structure must be uniform or equitable. It prevents companies from treating independent directors or women directors as second-class citizens in the boardroom.
I love that. Which brings us nicely to segment 5, transparency and accountability. We've spent a lot of time talking about what these executives can get paid. Now let's talk about who gets to know about it. Because in many corporate cultures, talking about your salary is totally taboo. But in corporate law, it seems to be mandatory.
Transparency is the best disinfectant, as they say. Section 197, subsection 12, requires listed companies to disclose some very uncomfortable, very public numbers in their annual board report.
Like what kind of numbers?
For starters, they have to disclose the ratio of remuneration of each director to the median employee's remuneration.
Ouch. So if the CEO makes 300 times more than the average worker on the factory floor, it's right there in black and white for everyone to see.
Yes, it essentially creates a legally mandated public inequality index for the company. They also have to disclose the percentage increase in the CEO's and CFO's pay versus the percentage increase for the average staff member.
So if the staff got a measly 2% cost of living adjustment and the CEO gave himself a 20% bump,
The shareholders and the labor unions and the press will see it immediately. It's designed to shame companies into maintaining some basic semblance of fairness, or at least force them to publicly justify the disparity.
and then there is what the notes call the top 10 list.
Yes, the top 10 employees disclosure. The board report must explicitly list the top 10 highest earners in the entire company, regardless of what their actual job title is. And there are specific financial triggers for naming other employees in the report, too. If you were employed for the whole year and earned more than 1.02 crore rupees, your name and salary go in the report.
So even if you aren't an executive, say you were just a star salesman or a really high-level software engineer making big bucks, you're in the report.
Yes. Or if you only work for part of the year but you earned more than 8.5 lakhs per month during that time, you're listed.
But why do we need to know this? Why expose the salary of a top salesman who isn't even making corporate policy?
It's partially about shareholders monitoring major fixed costs, but there is also a very specific anti-nepotism rule tied into this, known as the relative rule.
Do tell. How does that work?
So if an employee earns more than the managing director,
Which happens sometimes, right? In sales or investment banking, the rainmakers can make more than the boss.
it happens. But if they earn more than the MD, and they hold 2% or more of the company's equity shares, and they are a relative of a director, then they must be named and fully disclosed.
Ah, I see the trap. That catches the sneaky scenario where the managing director says, I'll take a very small, modest salary so I look great to the public, but I'll hire my son as a consultant and pay him 5 crores a year.
Exactly. It forces that shady arrangement right out into the light. It stops the controlling family from quietly extracting the company's wealth through the payroll system rather than declaring dividends. It's a very clever little trap designed to catch nepotism.
Speaking of keeping the money fair, there's a section here on the recovery of remuneration, or what we usually call clawbacks. Section 199. This feels like a very modern addition. We heard a lot about clawbacks after the 2008 financial crisis in the U.S.
Yes, this is essentially the crime doesn't pay section of the Act. Suppose a company reports absolutely amazing, record-breaking profits in 2024. Based on those incredible numbers, the CEO gets a massive performance bonus. Everyone is thrilled.
Champagne all around, stock price goes up.
But then, jump ahead to 2026. It turns out the books were cooked. There was massive accounting fraud or serious noncompliance, and the company is forced to restate its financial statements. The real profits for 2024 were actually zero, or maybe even negative.
So that massive bonus was based on a complete lie.
Exactly. Section 199 steps in and says the CEO must refund the excess money. They cannot legally keep a bonus that was earned on fake numbers. And here is the important part. It doesn't matter if the CEO personally cooked the books, or if they just passively benefited from someone else's fraud. If the financial numbers change, the pay changes retroactively.
Can the company just say, you know what, forget it, keep the money, we still like you? Maybe the board is really friendly with the CEO.
Generally, no, they cannot. To officially waive that required refund, the company would need to pass a special resolution. You have to go back to the shareholders and basically say, hey, we know he didn't actually earn this money, but we want to let him keep your millions anyway. Good luck getting 75% of shareholders to vote yes on that.
Yeah, that's not happening. And I imagine the banks wouldn't be too happy about it either.
Correct. The law adds another layer. If the company has defaulted on any bank loans or public deposits, the bank or financial institution has to explicitly approve the waiver too. So it's incredibly hard to just let it slide.
All right, we are in the final stretch now. Segment 6, exit strategies and governance checks. Getting fired or leaving the company. We constantly hear about golden parachutes in the business news, executives getting huge multi-million-dollar payouts when they leave, even if they perform terribly. What does the Indian law say about this? Can I get a massive payout for failing at my job?
Section 202 covers what's legally called compensation for loss of office. First off, it clarifies that this protection is only for managing directors, whole-time directors, or managers. Regular, non-executive directors do not get severance packages mandated by this section.
Is there a strict cap on the payout?
Yes, there is a very strict cap. The payment cannot exceed the remuneration they would have earned for the remainder of their term, or 3 years, whichever is shorter.
Whichever is shorter. So if I have 4 years left on my contract and I'm let go, I only get a maximum 3 years pay. But if I only have 1 year left on my contract, I only get 1 year's pay.
Correct. You don't get some arbitrary 10-year mega payout. It limits the financial damage to the company. And arguably more importantly, there is a specific list of no pay cases.
Scenarios where you walk away with absolutely zero.
Yes. You get nothing if you resign voluntarily. Because why should the company pay you a severance for choosing to quit? You get nothing if the company is winding up due to your own negligence. You get nothing if you are guilty of fraud or breach of trust.
Makes total sense. And,
Yeah.
wait, what's this one? If you instigated your own termination.
Yes, that's a real provision. If you deliberately try to get fired just to trigger the severance check, like acting out, refusing to work, causing a scene so they have no choice but to fire you, the law says no payout. It's legally called instigating termination.
I love that they had to write a rule for executives acting like toddlers to get a payday. So that covers the executives. Finally, before we wrap up, we need to talk about what I like to call the conscience of the company secretary and the secretarial audit under sections 204 and 205.
We mentioned earlier that the CS is a key managerial personnel. Section 205 defines their role as far more than just a scribe who takes minutes at board meetings. They are the chief compliance officer. They report directly to the board on whether the company is complying with the act. They ensure secretarial standards like SS1 and SS2 are strictly followed. They are the ones legally obligated to raise the red flag when the board tries to skip a step or break a rule.
And what exactly is the secretarial audit?
This is a mandatory external audit for listed companies and for large public companies with paid-up capital over 50 crore or turnover over 250 crore. An independent practicing company secretary comes in and checks the company's governance health.
So it's like a medical health checkup, but specifically for following the corporate rules.
Precisely.
Yeah.
And the liability for failing these rules is very real. The source notes cite a great example, the Usha Martin telematics case. The company had failed to appoint a required CFO and CS. They got caught, and they tried to just pay a fine, what's called compounding the offense, to make the whole thing go away.
Basically just write a check to the government and move on.
They tried. But the tribunal held that the ex-directors were personally liable for the period they were in charge when the violation happened. You cannot just pay a corporate fine out of the company treasury and wash your hands of the responsibility.
That is a very sobering thought to end on. Personal liability. You can't just hide behind the corporate veil if you willfully ignore the instruction manual.
It forces executives to have real skin in the game.
So let's bring this all together. What is the big picture here? We've talked about age limits, salary caps, clawbacks, dual MD loopholes, and secretarial audits.
The big picture is balance. We started with that cockpit analogy. These laws, Section 196 to 205, they are the flight manual. They are trying to balance the need for a strong, empowered pilot, the managing director, with the ultimate safety, the passengers, the shareholders. They prevent the pilot from locking the door with tenure limits. They prevent them from taking all the food with remuneration caps. And they prevent them from crashing the plane without personal consequences through liability and clawbacks.
It really reframes how you look at corporate law. It isn't just boring paperwork. It's a massive, complex system of checks and balances designed specifically to keep human nature, greed, and power in check.
Absolutely. The structure of a company isn't just a business decision you make on a whiteboard. It is a rigid legal structure designed to prevent the dangerous concentration of power and ensure fair play. It fundamentally acknowledges that absolute power corrupts, so it legally forbids absolute power.
Well said. Here is my final thought for you, our listeners, to mull over as we wrap up. We talked about the strict 70-year age rule and the hard 11% salary cap. These are very strict regulations. Now, put that in the context of a hyper-competitive global market where U.S. CEOs can often work until they are 90 and earn 500 times the average worker's salary without blinking. Do strict regulations like these hinder Indian companies from hiring the absolute best, most aggressive global talent? Or do they actually save Indian companies from the massive excesses, the greed, and the catastrophic crashes we've seen in other less regulated markets? Is it better to be safe and equitable, or is it better to be totally free and ruthlessly efficient? Efficiency versus equity.
That is the multi-billion rupee question, and how we answer it might just determine the entire future of Indian corporate governance on the world stage.
Definitely something to think about. Thanks for joining us on this deep dive. We'll see you next time.
Goodbye.